Hello, welcome to TradeMaster's Boot Camp. I'm Britton Ryle. This is Jason Cimpl, technical analyst and trading strategist for the TradeMaster Daily Stock Alerts Advisory Service. And today we're endeavoring to remove some of the mystery out of stock price movements. We believe stock prices can be understandable, predictable, and profitable if you know what to look for. So let's just get started straight away with some of the basics. Jason?
Sure. One of the most important things to remember about investing and trading, for that matter, is you're dealing with a market made up of people. And when you're dealing with people who are buying and selling, that market is going to be prone to those people's emotions, namely fear and greed. So it's important to recognize fear and greed in the market because that will drive the direction and the price.
You know, we've certainly seen some great examples of fear and greed driving, stock and asset prices over the last couple of years, like when oil was driven to $147 a barrel. People were just flat out greedy on it, and fear drove the S&P down to 600s in March of 2009 as well. So yeah, it's definitely, you can see the effect of fear and greed on the market for sure.
Right. Ultimately, the market is prone to human psychology, so it is prone to whiplashes based on human emotion, and that's why I like technical analysis, because that really captures the emotion and captures the trend in which people are trading and moving stock prices.
Because after all, the trend is your friend, whether you're investing or trading. Now, Jason, the talking heads that we see in the financial media, commentators you see on CNBC will often tell you that trading is just a great way to lose all your money as fast as possible. But over the last few years, you've managed to lead your traders to gains 2 out of 3 times you've entered a trade, which is a pretty phenomenal track record. Give us a little insight as to how you've managed to have such success trading in the stock market.
Sure. Well, first, we're not day trading. Our typical holding period is between a week and a month, so we're taking advantage of the shifts in investor sentiment and really just following the trend and staying with the trend, always investing in the trend, and getting out with a profit. And that brings up the number 2 reason is we set firm stop losses.
Right.
So we're cutting those losses quick, and we're increasing our stop losses as our position becomes profitable to lock in the gains. It's important for traders to never let a winning position turn into a loser.
I know that's frustrating, and that's why you have rules such as like Warren Buffett's first rule of investing, right? Never lose money.
Exactly.
It's always a nice way to begin.
Exactly.
And talking about Buffett, we think of him as being our greatest, living investor, and we hear that he definitely scoffs at short-term trading. How would you respond to that sort of perspective?
Well, Warren Buffett certainly made a name for himself as a long-term investor, right? But Warren Buffett also brings a little bit of a technical analysis into his portfolio as well. I mean, Buffett is known for buying when others are fearful and selling when others are greedy. And that's technical analysis. That's not fundamental analysis. That's taking advantage of the trend and investor sentiment. So even though Warren Buffett might not be a short-term trader, he still picks his entry and exit prices very carefully.
Yeah, savvy old fox he is. I would like to add too that we've seen Buffett act as a trader. Most recently during the financial crash of 2009, clearly he waited until everybody was losing their minds and then stepped in and started buying Goldman and some other things. And he was also short the dollar the whole way down too. I mean, he had some pretty obviously trading positions on his books during that time. So anyway, I'll be sure not to tell Warren you called him a trader next time I talk to him. But it also brings up another interesting point of fundamental versus technical analysis.
Right.
Give us a little insight here about whether you consider fundamental analysis when you're trading, or if you're only looking at price movement and only considering technical analysis when you enter a trade.
Right. Well, for trading is predominantly technical analysis, but it is important to remember, and I remind subscribers constantly, that everything comes back to fundamentals. Fundamentals do matter in the long term, but again, we're not investing for the long term. We're taking advantage of the fluctuations in price and investor sentiment, and to do that best, I utilize technical analysis.
Right. And by fundamental analysis, you mean like economic growth, earnings growth, that kind of thing, right?
Exactly.
Right.
Exactly.
And we see investor sentiment expressed in kind of like longer term moves, which we tend to call the trend, right? Like that's you see like a long price movement up or a long sell-off down. So we're going to start off with some trend analysis, like how to recognize which direction stocks are likely to head. So
exactly. There's some very basic ways to identify trend, and that is the most important thing to do for a trader to become profitable.
Sounds like we're about ready to go to the charts, Jason.
We are. Let's go.
One of the most important decisions that every investor faces is figuring out what the trend is. And there are many ways to do it, but one of the easiest and most popular ways is looking at the moving average to determine trend. A moving average is simply calculated by adding the closing prices for your subset and dividing by the total number of closing prices in that subset. So for example, a 5-day moving average would be the total of the previous 5 closing prices divided by 5. And moving averages are a nice way to spot trends and very easy to recognize the trend once it emerges. If the moving average is rising, the trend is considered up. If the moving average is declining, the trend is considered down. Another method is by comparing the price to the moving average. If the price of the stock you're following trades above the moving average, the trend is considered bullish. If the price is below the moving average, the trend is considered bearish. The third way is comparing short-term moving averages to long-term moving averages. If a short-term moving average is above a long-term moving average, so if the 10-day moving average is, let's just say, above the 50-day moving average, the trend is considered bullish. The opposite is true. If the long-term moving average is greater than the short-term moving average, the trend is then considered bearish. So let's take a look at a chart and see how moving averages work in real life. You can see that for shares of Southern Copper, SCCO, shares traded in a strong bullish trend from August to December of 2009. Shares traded above the 50 and 200-day moving average. But in January of 2010, weak earnings and a generally tepid stock market took shares below the 50-day moving average and were falling significantly on high volume towards the middle of January. Many investors wondered if now was the correct time to buy or sell. We decided that the long-term trend was bullish as long as the 200-day moving average stayed intact. So we took a long position in shares of Southern Copper in early February, anticipating that the 200-day moving average would hold and the long-term bullish trend would remain intact. Sure enough, shares rose over the next few months 30% to the mid-30s from our entry price around 26. In January of 2010, shares of U.S. Steel experienced a similar decline to Southern Copper, and many investors were again asking themselves, should they be selling stock or buying more? And the moving averages provided long-term investors with a great entry price in late January and early February that year. You can see, although the 50-day moving average was breached by January 20th, the 50-day moving average was still trending higher, meaning that the 50-day moving average was still increasing. It also was above the 200-day moving average, which was increasing as well. So both of those moving averages still indicated that the trend was higher. Now, although price was below the 50-day moving average, price stayed above the 200-day moving average, indicating that long-term investors would likely support shares along the 200-day moving average. We went long the stock in early February, expecting to get price appreciation as long-term investors protected the 200-day moving average and long-term bullish trend. Shares quickly moved to the high 60s over the next 2 months from our entry price around 44.
You've just watched part 1 of the 5-part TradeMaster Boot Camp series, helping traders trade more confidently in today's market environment. If you'd like to access the other 4 parts of the TradeMaster Boot Camp series, then go to the website www.trademasterbootcamp.com and enter your email address, and we'll send you the other 4 parts of the series. Again, that's www.trademasterbootcamp.com.